Hello guys, welcome back to another Lumley trading video. In this one we're going to be going through debit spreads, what they are, how you can use them. And debit spreads are just a form of vertical spread, meaning they're different strikes but on the same expiration date. So firstly as well, I just want to say we will be going through this example using Palantir, which is picker PLTR, and the reason for this is one I'm actually personally taking, so we can go through it in a live market, and then, you know, if you're watching this a week or a month down the line, you can see how did this perform in an actual market. So firstly, for this you want to find a stock that's firstly kind of overbought or oversold, depending on which way you want to do it. For this example, we're going to do ones that are overbought. So for how I personally do technical analysis, I can see, okay, Palantir, it's up around $10. To me, it's above then the second deviation on the 6 month, which to me is extremely overbought. It's coming into its third deviation also on the 6 month and its second deviation on the 1 year. So really, from how I trade from a technical standpoint, I expect really the stock to do quite a heavy pullback coming into this level. Knowing that, that's how I'm going to form my trade. So I can see, okay, I don't expect it to really get much above $10, and even if it does, I expect at least a pullback in the meantime. So, okay, I know $10 is where I expect it to go below, and really it's becoming very overbought. I just expect it to pull back in general. So all you would do is come over to the option chain. Really, you don't want to be doing less than probably 30 days, or probably less than 20 days, just because, again, you want to give it time to play out. So, you know, for this example, we'll go through maybe a 23-day expiry, but really you can do this as far out as you want. It's really going to depend on the stock though. So, you know, on a Tesla, you can really go out far because there's a lot of liquidity in the options. Something like Palantir, okay, yeah, you're going to have some volume, but you're not going to be able to go out, you know, 338 days. You can see there is just no volume. Whereas if we go out, say 23 days, there is volume. You know, 400 contracts, again, still not massive, but enough to be able to take the trade. So we will go for a shorter term expiry, and again, depending on the stock, you know, if you're doing a Bed Bath & Beyond when it's pumping, there's probably going to be quite a lot of volume going through all the expiry. So again, it's always looking down to what expiries have the volume, because that's really going to be key, because again, you want to be able to get in and out of the trade when the spread isn't massive. So Palantir, okay, we're now on the option chain. Again, if you're using some platforms, you'll be able to do this automatically. You can just select vertical and it will do the premiums in one. But if you don't have that, all you would do is go over to single. You'll be looking on the put side, and all you would want to do is you would want to buy the more expensive one, so the higher strike. So you can see that there, it's 46 cents. So we'd be buying that, but then we would want to sell the cheaper one. So in this case, that would be the $9. And then we can see this creates a debit of 17 cents. So again, this is what we would pay out. This would be our max risk. Obviously, if we take that up, we do 2 contracts, okay, then you're risking, you know, much closer to kind of $35. So that's always the thing, is obviously the more contracts you increase, the more risk you have, but overall your max risk is always defined to what your debit is. So that's the only good thing with the strategy as well, is you have defined risk going into this trade. So that's kind of how you set it up, how much you're going to pay, what your max risk is. Now, what is your max reward going into a trade like this? So if we analyze trade, we can see kind of how this performs. So again, we'll be getting in around now. We can see we would have our max loss if at expiry we're above $9.55. And we would have our max win if it closes a bit below $9. So again, this is why it's really key to finding the levels you want to do this at. Because again, we go over onto Palantir, we can see, you know, at $10, really I expect it to start pulling back. And the reason I picked the strikes I did, and we'll go through that in a second, is, okay, I still expect it to really start closing most likely back down to around 830. 830 would be my target. So I expect it to close below $9. Now, the reason I chose these strikes instead of maybe the 10 and the 9.50 is you get a better risk to reward. So you can see we're paying out, say, 17, 18 cents for this. We go over to analyze, obviously risking $17 then per contract that we buy, but we make $33. So, you know, we're getting near enough a 1 to 2 risk to reward. And that's the benefit of going out for different strikes. But obviously, if you only expect maybe a smaller pullback, you can go to the current value. So, you know, you could do maybe a 10 and a 9.50, and then you can see that's a 1-to-1 dead on risk to reward. So if we delete that, we can see obviously we're risking $24, but we will make 26 if it pays off. So that's always a thing. You can go make it a bit maybe harder to win, but you do get a better risk to reward. So it's really expecting how much do you expect it to pull back. And again, if you watch this channel, you maybe trade the standard deviation strategy. You know, if we're maybe trading the first deviations, we're going to be using, you know, a one-to-one risk to reward, because we don't expect the pullback to be as great, and maybe even the same on a second. But when we're pushing out to this third, really this is becoming extremely overbought. I really expect a heavy pullback. So again, I'm looking for that better risk to reward on that trade. And again, you don't even have to hold it to expiry, so you don't have to hold it for the 23 days. You know, if you see, you know, tomorrow the stock falls maybe 5-10%, the premiums go up, you know, 20-30%, you can just close out the trade there if that's what you feel comfortable doing. Again, this is a strategy you can hold to expiry, or you can just take it out early, just depending on really where you're sitting in the trade. You know, if you're up 80% on the position, there's no point really holding it to expiry if you still have 10 days say left, because there's a lot of risk that maybe it bounces and you then don't profit from the trade. So it's all about adjusting it, but we really just wanted to go over kind of what the strategy was and when to use it. And one thing we will quickly go over is, and again, that's the whole thing. I mean, they're very simple to understand. You're buying the more expensive one, and the reason I say the more expensive one is because if you're doing it on the call side, so again, if you're more bullish on a stock, you're going to be buying the more expensive one, and you're going to be selling. You're going to be buying the more expensive one. You're going to be selling the cheaper one. So that's why I just say it like that, because then it's simpler to understand. If you do it the other way, it will create a credit spread, but that's not what we're going through in this video. The great thing with this, and again, I did actually personally trade this multiple times, and this is when I really focus on it, is when you see big movers. If you kind of see Wall Street bets, or kind of just the majority of people, or if it's just, you know, you're in a taxi and you hear someone say about this stock, or you're on the street where, you know, the majority of people know about the stock, again, you already know more likely than not it's going to fail, because that's the reason everyone else is talking about it. People are going to be dumping it, so all that's going to happen is a pump. And again, we saw that exactly on Bed Bath & Beyond. It had its massive pump. So this is exactly how I traded this. And I remember hitting in the first contract, I think it was at $10. So I hit in with my first contract size here, and it still made the max profit. Now, the reason for that is, again, you don't have to time it perfectly on these debit spreads, and that's what's so great with them. Especially if you're holding to expiration, it doesn't matter if it goes up to $30 like it did here. Obviously, if we were shorting outright shares, we would have been down 200%. But trading through the debit spreads, our risk was defined, and we knew, okay, you know, going out a month or two, it is going to close below here because it's just extremely overbought. So it pulls back down, and again, then they expire, max profit, and that's really the great thing with them, especially as well if you can get them up here. Again, the better you time it, obviously the better it is, but it's more just kind of show you it doesn't matter if you mistime it, as long as you're still getting it at a bit that you kind of know it's still going to fall below. And that's when I think these stocks are really great for doing it. Bed Bath & Beyond, AMC, GameStop, really whenever you see these stocks pump, it traded exactly here as well. You know, pushed up to our first deviation. To me, that's a technical indicator that this stock is overbought. It's most likely going to pull back. Again, this was more of just a day trade because I didn't really want to take on too much risk because it hasn't gone extremely overbought, but it's that same principle. Is if it becomes overbought, I'm expecting it to pull back, especially on these pump and dump stocks where they just pump for a few days and then we get that strong sell-off. They're quite predictable, and again, if you can get a 1-to-1 or a 1-to-2 risk to reward, you know, you're not really taking on much risk compared to how often you're going to win with this strategy. That's why I really like it. Again, if you're using it on the bigger stocks, you know, a Nvidia, a Tesla, your win rate's definitely going to go down because it is not going to be as predictable. But if you do it on these pump and dumps when they have liquidity on the option side, it tends to be quite an easy strategy. So again, obviously go back test it if you can. If you've got a platform like Think or Swim, obviously you can do the on-demand feature. You can place the trade and then go into the future and see how it would have performed, how it performed when it was at its high, how it performed once it sold off. Really just get an understanding of how they move, how the contract values move as the price and the stocks move. And it's just go back to different examples. If you want to test it on large caps, test it on where you would normally short or go long on large caps, and if you maybe focus more on small caps, again, focus on those. But it's all about obviously understanding the trading strategy is easy enough. It's finding how you want to do it, or kind of when you want to execute it, and the stocks you want to do it on. So anyway, that is the breakdown. If you have any questions, definitely let me know in the comments. And if you want more information on it, you can always check out the Lumley trading website. It is linked in the description, where we have a whole section focused on vertical spreads. Anyway, I hope you enjoyed the video. If you did, why not drop a like and subscribe, and check out this video here.